Hey team, I'm David Warshaw, Certified Financial Planner at the WealthPlan LLC. And today we're talking about the 5 tax tips for W-2 employees because I want to show you practical, real-world ways to actually save money on taxes, strategies that nearly anyone can use. Shall we begin? Tip number 1, max out your retirement plan contributions, like your 401k or 403b plans. Pre-tax contributions are like a cheat code for your taxes. By just saving money for your retirement in these special account types, you lower your income, which in turn lowers your taxes. Remember, we have an income tax system. Less income, less tax. Let me give you a straightforward example. Let's say you make $100,000 a year and decide to put in $15,000 into your 401k plan this year. By making this move, this would reduce your federal income tax bill by $3,300, a whopping 22% tax savings rate. You see, once the money is in the plan, you get another tax benefit called tax deferral or tax deferred growth. In a taxable account, you're paying the IRS as you go. Interest and dividends are taxed yearly, and capital gains taxes will hit when you sell. That's a constant drag on your growth. But in a qualified retirement plan like a 401k, 403b, 457, or even a traditional IRA, none of those taxes apply. The interest, dividends, and capital gains all compound untouched year after year until you withdraw your money in retirement. And that's the magic of tax deferral. For a better understanding of these accounts, check out my tax diversification video where I break down the power of taxable, tax deferred, and tax-free accounts. Tip number 2, utilize an HSA or FSA. First, HSAs or health savings accounts. When you contribute to an HSA, your contribution is tax deductible. The monies then grow tax deferred, and distributions come out tax-free when used for qualified medical expenses. It's the only triple tax advantaged account the IRS offers. You can also roll over unused HSA funds year after year. There's no deadline to spend the money, totally a tax trifecta. Now, FSAs or flexible spending accounts. FSA contributions are tax deductible and can be used for medical or dependent care expenses. Awesome. But with FSAs, most plans have a use it or lose it provision, so you need to spend the money within the plan year to avoid losing it. Bottom line, use an HSA if you're eligible. It's a long-term wealth builder. To contribute, you need to be enrolled in something called a high deductible health plan. And for FSAs, use them smartly. It's a great short-term tax break if you plan carefully. Tip number 3, use the bunching method to itemize. Most people miss out on thousands of dollars of tax savings because they automatically take the standard deduction each year. Instead, consider a strategy called bunching. Bunching means you stack 2 years' worth of deductible expenses into a single tax year so that you exceed the standard deduction and can therefore itemize. Then in the next year, you go back to taking the standard deduction. By alternating between itemizing and taking the standard deduction, you reduce your total tax bill over time. Itemized deductions include mortgage interest, property taxes, medical expenses, and charitable donations. So you may be wondering, Dave, how exactly do I do this bunching technique? Well, here are a few ideas for you. You could bunch by doubling or tripling your charitable giving into 1 year. You can prepay your property taxes if your town allows it. You can schedule elective medical procedures into 1 calendar year. You can prepay January's state estimated tax payment in December of the prior year, or you can use a donor advised fund for your charitable giving. Speaking of charitable giving, that brings us to tip 4, using a donor advised fund or DAF to boost your charitable impact and your tax saving. It's a simple account with 5 powerful perks. 1, you get the full tax deduction up front, even if the money isn't granted to charity for months or even years. 2, you could donate appreciated assets like stocks or ETFs. skip the capital gains tax and still deduct the full market value. 3. Inside the DAF, your contributions can grow tax-free, giving you more to give later. 4. Like we saw earlier, DAFs help you with the bunching strategy. By stacking several years of donations into one year, you could then itemize your taxes that year to save more. And 5, the best part, flexibility. You get the tax break today, but you could decide later which charities get the funds and when you wish to donate them. One heads up though, once you contribute, it's a done deal. No backsies, no givesies. The money's locked in for charity. Tip 5, avoid underpayment penalties. Look, paying taxes is bad enough, but paying penalties because you didn't pay enough? I mean, that's just insult to injury. Now you might be thinking, what you talking about, Willis? Well, the U.S. tax system is a pay-as-you-go system, meaning the IRS expects taxes to be paid throughout the year, not just at filing time. And if you don't pay enough during the year through paycheck withholding or quarterly estimated payments, the IRS charges penalties and interest. And even if you settle up by April 15th, you could still owe hundreds, even thousands in penalties. Here are 5 simple ways to avoid it. 1, follow what's called the safe harbor rule. You pay at least 100% of last year's tax owed, or 110% if your adjusted gross income, or AGI, was over $150,000. 2, adjust your W-4 withholding. This means you increase your paycheck tax withholdings. It's fast, and those dollars count as if they were paid evenly throughout the year, even if you adjust late. 3, make quarterly estimated payments. This is especially important if you have side income, bonuses, RSUs, or a business. Quarterly due dates are April 15th, June 15th, September 15th, and January 15th. 4, front load payments if you're behind schedule. If you're short mid-year, make a big catch-up payment as soon as possible, because the IRS calculates those penalties quarter by quarter. And 5, plan for windfalls. If you sell a business, exercise stock options, or cash out investments that have done well, pay estimated taxes immediately. Don't wait until next April. The IRS expects payments as income is earned. And I got a bonus for you because you stuck around with me this long. The last tip is open up a business. Having your own business opens up an entirely different world of tax planning strategies, but that's definitely a topic for another video or 2. Heck, even 3. So stay tuned for that. Before we wrap up, I've got to give you a quick pop culture break. I mean, you've earned it after making it through a tax video. Props to you. Diana and I just finished watching Shrinking on Apple TV with Jason Segel and Harrison Ford. We absolutely loved it. It had us laughing. It had us tearing up. The whole deal. 2 seasons of brilliant TV. I'm giving it a solid 8.5 out of 10. Okay, so to wrap this video up with a tiny bow, there's tons of low-hanging fruit to help minimize your tax liability for 2025. But remember, while these are powerful strategies, they need to be coordinated with your accountant and your financial advisor. The concepts are macro, but your personal plan needs to be micro. Thanks so much for watching. I'll see you in the next video soon. Take care. Bye-bye.